what we've discovered in representing dentists for over 53 years is that we started experiencing changes in reimbursements to in-network physicians, which normally didn't affect dentists. And so dentists being fee-for-service really weren't as impacted as the physicians were. However, that's starting to change now. And so we did a focus panel about 10 years ago saying, we believe that you are being suggested to, in your continuing education and your study groups, to increase revenues by seeing more patients, adding more procedures, or cutting overhead. And what we did was we said, look, why don't we take a look internally? Why don't we take a look at, are there profit centers in a dental office, dental practice, that could be discovered and exploited? And what we found were a series of profit centers that were totally ignored, that are not what we call patient-centric, meaning you don't have to see one patient, you do not have to cut your overhead by 1 penny, and you can develop these profit centers, and they're recovering, they reoccur every year. So today we're going to chat with you about 5 of those profit centers, how we can help you determine what they are, how we can help you enjoy exploiting them from the standpoint of developing revenues. And we're going to show you exactly how we do it from that standpoint. I presented at a national conference recently, and the speaker got up. There were about 200 people in the room, and Mr. Dickey was there as well. And the first words out of his mouth were that 15% of the people who were sitting in the room would run out of money within 10 years of their death. Well, I found this rather alarming, because most of the dentists that we represented were in practice for a period of time, building a brand, and that 15% of the people in that room, statistically, were going to run out of money within 10 years of the date of death. So what we're going to show you today is going to create means by which you can avoid that. We're going to fill the gap with the profit centers we're identifying. What we're going to do is we're going to assume that your practice is exactly like a gold mine. And within the gold mine, there are nuggets. And these nuggets have been invisible in plain sight for many years. And we're going to show you how to exploit or mine those nuggets, and they recur every year. So with that, I'm going to turn this over to Doug Dickey, the CPA, and we're going to get on with our presentation.
Thank you, Walter. The slide you just seen about being on autopilot has to do with structuring and operations. As Walter mentioned, there are so many changes been happening in your industry. And if you went into practice 5, 10, 15, 20 years ago, and you were structured as just a flow through into either S Corp or partnership, and you've not looked at how your business is structured or income is received, then you've probably been on autopilot. Because if you think about the regulatory change, the reimbursement rates or fees, the cost of labor, equipment, facilities, they've all skyrocketed and changed dramatically. If you aren't staying in sync with what's happening in your industry from a tax and from an operating structure perspective, you're probably on autopilot. And that was what that picture was representing. As the screen you see before you indicates, our concept of tax planning is for our clients to only pay tax on what you consume, not what you earn. So by consumption, we mean if you use it for your home, for food, for clothing, for vacations, if you use it for personal expenditures, you earn it, you use it for those expenditures, you're going to pay tax on it. There's nothing we can do about that. That's the way it works in America. But to the extent that you're fortunate enough and you work hard enough to have earnings in excess of what you need to consume, now there are opportunities to be able to make a difference on how your income is taxed. All too often we see people paying tax at the highest rates that the law provides for earnings in excess of what they need to consume. So they're working hard to earn these additional dollars, but they're subjecting those dollars to a far greater rate of tax than what they have to. In order to make changes, we ask that you turn off the autopilot and you become proactive, not reactive. You look at where you are today, where you want to go, and what's happening around you, and you structure yourself in such a way that you optimize your tax picture rather than reacting to what your CPA tells you need to pay on April 15th. So being proactive rather than reactive allows you to be able to properly plan so that you pay tax on only what you consume. We also take a look at folks from a standpoint of asset protection, because unfortunately, there are people out there that will do you harm or intend to do you harm. They'll try to take your assets, they'll sue you, they'll do mean things to you. So if you're going to work hard and you're going to accumulate wealth and assets, you owe it to yourself and your family to also protect your assets and your holdings from these people as well. And we'll talk some about that here this morning also. To everyone listening to this webinar, there's probably no surprise in the graphic you're seeing, unfortunately. It's no secret that reimbursements per case or procedure are going down in healthcare, especially for physicians and dentists, the service providers. It's also no secret that costs have gone up. You look at the cost today of your equipment and what it takes to set up your operation, your rent, your labor. Compare that to what it was 10 years ago even, or certainly 15 or 20 years ago. And you can see a drastic squeeze on healthcare and the healthcare providers. That's where this healthcare reform seems to come in the flavor of what can we take away from the provider and disperse elsewhere, which is unfortunate and inappropriate, because after all, you guys are healthcare. You're the ones that are providing the healthcare services. But any business that has income decreasing and cost increasing is ultimately heading to a point of unsustainability. When a business costs are in excess of what they're able to generate, you lose money and you go out of business. And you see that, if you look back 20 years ago, 25 years ago, we saw it coming heavily with physicians. You saw groups banding together. You saw management services organizations coming together to try to create economies of scale. You saw smaller solo practitioners joining larger groups for the same reason, and ultimately you saw those larger groups being sold out or bought up by hospital operating groups as well. And that's sort of the trend that's been happening with physicians. Well, the same thing's happening in dentistry today as well. You're seeing the solo practitioner getting squeezed from a cost perspective. You're seeing groups of practitioners band together for economies of scales and to be able to create income streams they wouldn't otherwise have access to. And then you're actually even seeing private equity groups come in with consolidation plays where DSOs are coming in and buying practices. So those of you in dentistry, look at physicians 20 years ago and you can see what dentistry will look like 15 years from now. Same trends and tendencies are starting to take place, and you're already feeling the effects of them, and you'll feel them even more as we go forward.
All right, Doug, before you continue,
sure.
This is the way we see most people, but I want each of the people who are attending this conference to ask themselves 3 questions, because these will be vital in assessing what we're about to tell you and applying it to your own situation. First question, how long do you intend to practice? How long do you intend to practice? You don't have to tell us, just keep that in mind. How long do you intend to practice? Number 2, what do you need to live on? We're going to show you how this is a critical decision. What do you need to live on per month? Number 3, do you have any debt, any business-related debt? Put that in your mind. Number 4, what did you pay in federal income tax on your 2018 return? The company return was due, I believe, on the 16th day of this month. So you now have your 18 practice return done. So just take a look at that. Your 1040 upon extension is due in October. So go back to the 2017 return. Just keep in mind how much tax you paid. We're going to show you how that's critical. So just keep those 4 questions in mind. Go ahead, Doug.
Thank you, Walter. The graphic you see on the screen is a representation of how we see most folks structured when they first come to us. You go into practice and either some CPA or attorney has talked with you about protecting your assets, and so they establish an entity to help protect those assets, and then they probably made an election under the Internal Revenue Code to have that entity taxed as an S corporation. We see most practices operating as either S corporations or partnerships. There's nothing wrong with an S corporation or partnership as an operating practice. But let's talk about some tax issues that may come into play when you're utilizing them. See, in our world, we look at different types of rules for different types of taxpayers. as individuals, as humans, we have one set of tax rules. As corporations have another set of tax rules, partnerships another set of tax rules, C corporations another set of tax rules, trusts and estates and so forth all have their own sets of tax rules. And there are pros and cons to each one of those. To us, the idea is to marry those to determine what's the best way to be able to structure income and expenditures under each of those rules. But let's see what happens when we look at just the pure flow-through model and how that impacts you as a taxpayer. So if you're set up as an S corporation or a partnership, whatever you earn between January 1st and December 31st is going to end up on your individual tax return. You're going to pay tax on it. You're going to receive income in two forms from your S corporation. The first is going to be a paycheck. You're going to get a W-2 that says, here's how much I have in wages. And then at the end of the year, you're going to get a K-1 from your CPA when they prepare the practice return. It's going to take the rest of the profits of that practice and dump it onto your personal tax return as well. So all income ends up on your personal tax return. Well, if your W-2 is high enough that it puts you already in a 32 or 35% tax bracket, and then you add K-1 income on top of that, and all the profits of the company are going to be taxed at the highest rates the law allows. You don't get to go back and reutilize the lower tax rates. All income on top of your W-2 gets taxed at the higher rates. Because in this country, we have what's called a progressive tax system, which means the more you make, the higher rates of tax you pay. So it's not only that you're paying tax at a higher rate on your profits from your practice, but if you have investments or real estate or other ancillary income stream, it's also dumping income onto your personal tax return, then that income is being taxed at the highest rates the law allows. So you're actually taking sort of a double hit, right? You're taking your earnings themselves, subjecting them to the highest tax rates you can, and then you're taking the after-tax dollars, investing them, and then taking the earnings on those investments and subjecting them to the highest rates you can as well. While that is an efficient way to pay tax because it's just one taxpayer, you, it is an inefficient way to accumulate wealth because we're taking your excess earnings in excess of what you need to consume to live, plus your investment earnings, and subjecting them to the highest tax rate that the law provides. Here is a structure that's not a new concept. We've been using it for decades to help folks, but certainly changed and got substantially enhanced effective January 1st of last year when the Trump tax bill came into being. What you see on the left side of the screen is really the same as what you saw previously. It's for federal tax purposes. It's an S corporation that's going to drop W-2 income and K-1 income onto the individual's tax return. One thing you will notice is in the previous screen, it was a PA, professional association, and in this screen, it's a professional limited liability company. And in a few moments, Walter can walk you through what the difference is and why you would want to be a PLLC if that's available in your state versus a PA. But for now, let's just focus on it from a federal tax perspective. From a federal tax perspective, there's absolutely no difference on the left side of the screen from the previous. It's an entity tax as an S corporation. It's going to drop W-2 income and K-1 income onto your personal tax return. Here's where a difference comes into being, and let's talk about why we're doing it and what the effect of that difference is for you. Each day when you go to work, you really are working in two businesses and have at least two, if not many more jobs than that. For a portion of the day, you do what you went to school for so many years to do, and that's you're practicing dentistry. You are providing healthcare services to your patient base. That's an outward-facing job, right? You're providing services to the outside world. But a portion of your day, you're a business person, just like anybody else running a business. You're dealing with things like HR and IT and accounting and sales and marketing and management and admin. You're dealing with the care and feeding of the business, not the delivery of services and the care and feeding of your customer or your patients. Currently, if you have all of your activity occurring in a single entity like the S corporation, then the earnings and profits from both of those jobs drop straight onto your individual tax return. It doesn't have to work that way. You can establish another entity and outsource those management services. In fact, you don't even have to establish them if you want to. If you don't want to staff your operation or even management. You can Google dental management firms and probably come up with thousands of different firms. You could outsource the complete management operation of your dental practice to an outside party. Well, you can do the same thing, but you can do it with your own company. In the middle of the screen, you see we've established another entity, a management services organization, an MSO. Sometimes they're called DSOs, dental service organization, but this one's about management services, okay? And we've elected to have this entity taxed as a C corporation. That management services organization is really separating you. It's bifurcating what you do every day. The activities that take care of the patients, the outward-facing activity, that will continue to be performed in the PLLC taxed as an S corporation. There's absolutely no change in that. There's no change to the public. There's no change in your reimbursement plans if you're in network. There is no change in your operations to that extent. What has changed is that those core services that are required for the care and feeding of the practice will now be conducted by that management services organization. And that may mean moving you or your bookkeeper or some of your office staff over into that entity, so that entity provides those management services. And here's why we would want to do that. Your operating company is going to earn money. It's going to take that money in and it's going to be taxed as income. If it pays for outside services, whether they're outsourced accounting and IT services or management services to a management company who provides those services and expenditures are deductible by the S corporation. So that reduces the taxable income flowing from that S corporation to you. That MSO is taxed as a C corporation. So that management fee that's deductible in the operating company is actually income in the C corporation. But effective January 1st of last year, that C corporation has a single flat tax rate of 21%. Most of the folks listening to this call are in a 40% tax bracket. The highest individual rate's about 37%. You put Obamacare tax at another 3.8% or Medicare tax at 2.9%, it's roughly 40%. So when people talk about the top tax bracket in the U.S. as being 40%, that's the basis for the numbers they're speaking of. So think about it. If we take $100 out of your S corporation, it reduces your personal tax by 40%. If we put $100 in the MSO, it increases the tax by 21% or $21. So in essence, we have saved $19 in tax on that $100, almost cutting your tax in half on earnings you don't need to consume. So we take a look at what activities actually take place in your operation. There's a management services agreement that is written and drafted between the management services organization and the operating company, identifying each of the services to be rendered. We prepare a management fee analysis to determine what's the fair market value of those services in your practice, in your geographic area, in your industry for a practice your size. And we have databases with the Department of Labor and also with MGMA that can give us insight on what that value would be. It's actually the same process the IRS would look at when it comes to reasonable compensation paid between related parties. These will be related parties. You own both companies. It is payment for services. So we're using the exact same process the IRS would look at on making sure that these are fair market value payments being made between the operating company and the MSO. That profit from those management fees is what is going to be changing from being taxed at 40% on your individual tax return flowing through from the S Corp to only 21% inside that C corporation. If you have 401k or defined benefit plans or profit sharing plans, all qualified plans will still be the same, whether it's an S Corp or a C Corp. Any employees of either company will be entitled to participate in both those plans. There's no discrimination. But for non-qualified benefits, things like medical expense reimbursement plans or compensation plans or disability payments or long-term care payments or deferred compensation, those can be discriminated. You can pick and choose the level of benefits for different classes of employees, and you can cover folks in the C corporation that you don't have to cover necessarily in the S corporation. So we first take a look at what amount of services are being provided from a management perspective in a business, determine what's the value of those, and then determine how much profit can be moved from your S Corp / individual tax return over to the C Corp, reducing your tax in half. We then take a look at how you spend money, because there are some things that are deductible inside that C corporation that aren't individually. Things like unreimbursed medical expenses. I would wager that anybody on this phone call has never been able to deduct unreimbursed medical expenses on their personal tax return, because you can only deduct those that are in excess of 7.5% of your adjusted gross income. Well, that C corporation can have cafeteria plans and medical expense reimbursement plans that allow you to deduct the first dollar of medical expenses. So if you have special needs children or spouses that have medical expenses, this is a way to more tax efficiently pay for those medical expenses. There's also a tax bracket arbitrage that comes in for paying for things with after-tax dollars. In a 40% tax rate, like you are as an individual for income flowing through from an S corporation, you have to earn $1.69 to pay a 40% tax rate and have $1 remaining. Well, in a C corporation with a 21% tax rate, you only have to earn $1.27 to pay a 21% tax rate and have that same dollar remaining. So paying for things with after-tax dollars is actually 42 cents per dollar cheaper in a C corporate tax environment than your individual. It's the difference between $1.69 and $1.27. So things that are paid for with after-tax dollars would be things like disability insurance premiums, right? You pay those and don't deduct them so that if you ever get disabled, the income streams will be non-taxed. Well, this is a way to reduce the cost for those disability premiums by 42%. Life insurance is another issue. People need life insurance to be able to provide for their family in the event something happens to them. Well, this is a way to be able to reduce the after-tax cost of paying for life insurance premium by 42 cents per dollar. So same benefit for your family, it just takes less earnings for you. So when Walter talks about profit centers, simply reallocating income streams based upon what you do and how you're structured in your organization, or who pays for what goods or services or benefits, can make a significant difference. This is a recap of the numbers I just sort of went through in the previous slide. If you assume a 40% individual tax rate, you have to earn $1.69 and 40% rate to have that dollar remaining. The C corporate 21% rate means you only have to earn $1.27. When I talk about it being 42% less, you can see where the 42 cents difference is. It comes from. It's a difference between $1.69 and $1.27. This is not rocket science. It's just pure math and structuring yourself in such a way that you can take advantage of the C corporate laws where they help you and the individual tax laws where they help you. We also want to talk about, from a numeric standpoint, what this can mean for just a set of normal benefits for a family. If you're in an S Corp environment and you're having flow through earnings that are being taxed at the 40% rate, then say you have life insurance and healthcare costs and long-term care costs that you're not able to currently deduct. That means you got $40,000 of benefits that are being paid with after-tax dollars. What that really means is you had to earn $67,600 to pay your tax and then have the cash remaining to pay for those benefits. Well, if we were able to deduct the healthcare and long-term care costs, then there is no tax, and that's what you see in the right-hand column. The life insurance, if we had to pay it $25,000 after tax, but we could do so in a 21% tax environment, we would only have to earn $31,750. The combination of switching these benefits to having them paid in the right place would reduce the cost to provide these benefits for a family by almost $36,000 per year. Not talking about buying another dollar of any kind of insurance or providing any additional benefit. We're just talking about paying for these things in a much more tax-efficient environment. You can see on the bottom of the screen, Walter asked the question previously about how many years you're going to continue to practice. Well, each year you do this, you continue to practice, you're going to compound the value that you can accumulate from your efforts. And if you just assume a 5% rate of return, you can see how this magnifies substantially over time. One other thing that people don't often think about is the tax cost of servicing debt. Right? When you borrow money, there's two things that you pay. The first is a rental charge for the money. Right? The bank charges you interest to rent their money. But the second cost you have is paying the principal, because principal on debt is not deductible. It is always paid with after-tax dollars. So let's assume you have a $1.2 million in debt on real estate or equipment, working capital, whatever it is with your practice, and you're in a 40% tax bracket. You're going to have to earn $1.69 for every dollar of principal, which means you're going to have to earn over $2 million to pay a 40% tax rate and have that $1.2 million remaining to pay to the lender. Well, if we could restructure that debt and put it in a C corporate environment, that would mean that you would only have to earn $1.27 for each dollar of principal, or $1.5 million in total. So it's a savings of $500,000 on $1.2 million in debt. That's real money. That's dollars you're currently earning that you would have to consume in tax to pay off debt. If we could take and restructure that debt into a 21% tax environment from your current 40% tax environment, it would save you the amount of money you're seeing over the life of the loan. Once again, you multiply that by whatever amount of years you're going to practice and assume even a reasonable rate of return of the 5%. And now we're talking about $1 million or more for the average practitioner. Walter asked previously, how much do you need to live off of, right? And by now you're probably catching the drift. The reason why is because whatever you need to live off of, you have to pay tax on. And look, we're not talking about lifestyle diet for anybody here, right? We have no desire to reduce anybody's lifestyle. Whatever you need to spend for your lifestyle, do so. You work for it, you earn it, it's yours. You're entitled to do that. But to the extent that you have earnings in excess of what you need to consume and you want to put those dollars away for the future, for retirement or other benefits for your family, then let's look at a more tax efficient way to do that. And that's what this discussion's been about. So assuming that you need $220,000 a year to live off of, right? If that's your standard of living. A lot of folks say $15,000, which would be $180, but let's just assume it's $220. In a 40% tax bracket, that means you have to earn almost $310,000 to pay your tax and have $220 remaining. Well, if you were to make $500,000 from your practice before wages to you, then that really means that you have $190,000 in excess of what you need to be able to provide for your lifestyle. Well, at a 40% tax rate, if we could take and move that $190,000 off your personal tax return, it would reduce your tax by $77,000 a year. Now, if we don't do any additional tax planning, you'd pay 21% on it, so it would be a 19-point difference, or about half these numbers. But there are ways to be able to reduce tax in the C corporation as well, with some of those concepts we just talked about in the previous slides. Assuming you had a $77,000 per year savings, multiply that times the number of years you're going to be in practice, and you can see how these dollars continue to stack on top of each other to be a significant retirement income stream that you would not otherwise have. Also want to talk about the concept of double taxation. Sometimes people hear C corporations and it's like an automatic reaction, say, but there's a double taxation, so therefore it must be a bad thing. And prior to January 1st, 2018, for decades prior to that, the answer was, maybe not, depending on how they plan for it, but probably could be. But effective January 1st, 2018, the issue of a C corporation shareholder being subjected to double taxation went out the window. And here's why. I'll walk you through the background on it. If you're in a flow-through entity, like an S corporation or a partnership, all that income drops down on your personal tax return. So you have to pay tax on it each year, right? Between January 1st and December 31st. And so there's a single tier of tax It's the highest tax the rate of the law allows, but it's only taxed once. Well, with a C corporation, it stands on its own. So whatever earnings it has, it pays tax. In this situation now, it's at a flat 21%. If you don't do any tax planning or tax deferral and you want to take that money out and use it individually, then you'd pay a dividend out of that C corporation. And dividends are taxed at 20%. So there's a second tier of tax on dividends taken out of a corporation. And that's where people say, tax me twice, that's bad. Well, the reality is it's not really an issue of how many times you get taxed. The real issue is how much tax do you pay? The goal is to pay the least amount of tax the law allows you to pay. So let's walk through some math so you can kind of see what I'm talking about. If you make $100 of income and you're in the highest individual tax bracket, that's 37% currently. Forget the Obamacare tax, forget Medicare tax. Let's just talk about pure income tax rates for a minute. Highest individual rate's 37%. So $100, a 37% rate means you pay $37 in tax, which would leave $63 after tax. Now let's assume we take that same $100 and run it through a C corporation. C corporations have a flat 21% tax, right, effective January 1st of last year. So that means you'd pay $21 in tax inside that C corporation, which would leave $79 profit after tax. Now let's assume no additional tax planning, no deferral, no additional thought goes into it. We just want to pull the money out and spend it. So you take that $79 and you distribute it, and let's say it's taxed at 20% as a dividend. 20% of $79 sounds a lot like $16, $15.80 to be exact. So $16 plus dividend tax plus $21 corporate tax means you would have paid $37 in tax to take that $100 and bring it through a C corporation and out to you individually. Well, that's exactly what you would have paid if you would have earned that $100 in a flow through it anyway. If you read the committee reports about what the House and the Senate were negotiating back and forth when they were looking at that tax bill, that's part of the negotiations. They were trying to bring parity between flow-through entities and C corporations on this double tax issue. And so there actually is no difference now between the flow-throughs and the C corporations for these ordinary earnings. There was previously, prior to January 1st, 2018, C corporations used to have tax brackets, just like we individuals have tax brackets. C corporations used to have the first $50,000 of profits taxed at 15%, next $25,000 taxed at 25%, and above $35,000 taxed at roughly 35 to 39%. So historically, we would only move about $75,000 profits plus deductible benefits over to a C corporation because that would allow us to utilize an effective 17.67% rate for those blended 15 and 25% tax rates versus at that time over 43% rate for the individuals. Effective January 1st last year, those limitations came off, folks. There's only one single flat tax for corporations, and it's 21%, whether it's $1 or $1 billion worth of profits.
Whoops.
This slide is the summation of a case we had gone through where we had a dentist had come to us that their family had grown, their kids had gone to school and gotten out of school, and they no longer needed all their income. We were able to drop their income by $260,000 using this MSO concept and take those dollars and put them into different benefit or risk management or retirement programs for them. But the numbers you see on the right-hand side of the screen are the Internal Revenue Code sections for each of the types of elements that they invested those dollars into, and ultimately paid zero tax on it inside their C corporation. So this particular couple, by dropping their taxable income by $260,000, put an additional $100,000 of cash in their pocket, and have continued to do so each and every year since then. So these numbers are for real. The code sections you see are actual parts of the law today. They're not something that has to be enacted by Congress. These are things you have a right to utilize today to help reduce your tax exposure.
So this slide really just goes back to that client that is making $520,000, 560. In terms of we got those dollars out of their personal income and over into the C Corp, what that meant for them. So this is the before picture of that client. They had gross income of somewhere around $600,000, but you can see their debt and tax costs here, about $263,000 are paying. And because of that, as far as lifestyle concerns and net worth, you can see when we started working with this client in 2015, their net worth was at about 1.2 million, and they had total assets of 1.9 million. And so by taking a look at this strategy that we're talked about today and what that meant for the client over a 3-year period, I want to move you to what this client looks like 3 years later. January 1st of 2019, you can see the shift in personal income where we dropped them down to about $250,000 of personal income that they're consuming. The rest of their income dollars actually flowed now to the C Corporation over the last 3 years. And the savings from a tax perspective is significant. They're paying about $100,000 of tax on an annual basis on their personal income. By doing that, over a 3-year period of time, they've increased their net worth to 2.3 million, and they've increased their asset base to a little bit over $3 million. So part of the strategy is, how do I pay less in tax? But the second piece of it is, once I have those savings, how do I make sure those savings are captured and brought back to my personal balance sheet? Because like any other situation, if you save money just to spend it, you're no better off, after you've spent that savings. The real key to this is, how do I drive potential additional savings for myself? And then how do I keep those savings and let those savings actually work for me and accumulate for wealth in the future? Another example of this is, taking the same client, they found about $250,000 of additional savings that came back on their balance sheet. If we simply increase that savings at a 3% rate year over year, which basically is keeping up with costs of inflation, and we get those dollars invested at a 5% annual rate of return, in 10 years, those dollars have accumulated to about 3.7 million. And what's even more powerful, if we can do it for another 5 years, so we've got a 15-year projection, we've got $6.8 million have now landed on the balance sheet of the client. Folks, that is real wealth. And this is how people get in situations where they truly get their independence back, where they no longer have to work, but they work because they want to. And that's where the power comes in.